Nobody on Wall Street covers this stock. Here's why they should. In 2025, Verano Holdings sold $822 million of cannabis at a 50% gross margin and still wrote the federal government a $78 million tax check. In a year, it lost money before taxes. A company that lost money, and the government still collected. This is the most undercovered corner of the public markets, and the math is stranger than anyone tells you. Start with the top line. Revenue climbed to a peak of $938 million in 2023, then slid 2 years running to $821 million in 2025, down about 6.5%. This is a mature operator defending its share in oversupplied states like Illinois and New Jersey, where a flood of new dispensary licenses crushed prices. This is not a growth story. It's a survival and margin story. Here's the number that makes cannabis different from every other industry. Verano paid $78 million in cash income taxes in 2025. In a year, it lost $166 million before tax. On an accrual basis, the current tax bill was $129 million. The cause has a name, Section 280E. And it is not a one-year fluke. Look across 5 years. Every single year from 2021 through 2025, Verano booked between $129 and $168 million of current income tax, more than $740 million in total, while never once reporting a profit. A company that has only ever lost money on paper, taxed like it was rolling in cash. Why does this happen? Section 280E is a tax rule written for drug traffickers. Because cannabis is still Schedule 1 at the federal level, Verano can deduct the cost of its product, but not payroll, not rent, not marketing, not interest. So it gets taxed on gross profit, not on real profit. A normal company with Verano's pretax loss would owe close to nothing. Verano owed $129 million. That gap is the 280E penalty. Now, strip away the noise and look at the actual business. Gross margin held at 50%. Adjusted EBITDA was $229 million, about 28% of revenue. The headline losses are mostly non-cash, $183 million of impairments in 2025. The boom-era acquisitions finally marked down to reality. Underneath the write-downs, this is a real, profitable retail machine. But there's a catch the market underrates. Verano doesn't just defer this tax. It formally takes the position that Section 280E doesn't apply to it at all, and reserves the amount it's disputing. And that bet scaled fast. The reserve was just $3 million at the start of 2024. It's $391 million today, built in barely 2 years. It even compounds. Verano added $37 million of interest and penalties on it last year alone, and prospective relief does not erase it. So what happens when the switch flips? Follow the cash. In 2025, $229 million of EBITDA turned into just $12 million of free cash flow, because cash interest and that 280E tax ate almost all of it. Remove 280E and free cash flow steps up to roughly $75 to $90 million. Same stores, same sales, 6 to 7 times the cash. On today's enterprise value, that turns a 1.5% cash yield into about 10%. And here's the kicker. Nearly 60% of Verano's retail sales are already medical, so a big chunk of that relief is landing in 2026, not someday. Only the adult use slice waits for a broad order. Which brings us to value. Verano trades around 3.3 times EBITDA and under 1 times revenue, the cheapest of the billion-dollar operators at about 0.6 times book. Consumer staples and wellness peers, the businesses Verano would resemble without 280E, trade at 8 to 14 times. Put even a partial re-rating on Verano's existing EBITDA and net out its debt. At 5 times, the equity is worth roughly $810 million at 8 times, around $1.5 billion, versus about $430 million today. That's implied value under stated assumptions, not a target and not advice. The footprint behind those numbers: 162 dispensaries across 13 states, anchored by Florida, 85 stores, medical only and growing, plus Pennsylvania, Illinois, New Jersey, and Arizona. That mix is the Catalyst map. Nearly 60% of retail revenue is medical, so most of the book captures tax relief first. And management is lining up Pennsylvania, Virginia, and Texas as the next adult use and medical growth markets. So here is the honest framework. The bull case: a 50% gross margin operator at 3.3 times EBITDA, where killing one tax statute multiplies free cash flow and a re-rating does the rest. The bear case: revenue still shrinking, a $391 million back tax bill that relief won't erase, a court challenge that could freeze the whole thing, and an uplisting that isn't even structured yet. This is high operating leverage on the tax code, priced today for the status quo. That's the setup. Verano is cheap for real reasons, and it's a coiled spring if Section 280E falls away. Watch 3 things each quarter: the current tax line, that uncertain tax reserve, and whether Verano announces a medical-only structure to uplist. We'll be tracking all 3. This entire analysis was built using RoboSystems, an open-source platform that gives you direct access to structured SEC filing data for every public company: revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. You can set up the same tools I just used in about 5 minutes. Head to robosystems.ai to get started. Link in the description.